Hi, Christian. 2023 proved to be a very strong year for equities, with S&P up 26%. And yet, markets were historically narrow, with only a small group of names driving much of the upside. Recently, we've seen a widening, and activity during the first few weeks of 2024 have indicated a potential shift in leadership. So how are you thinking about this, and how does this interpret in terms of opportunities?
It certainly feels that there's some complacency in financial markets today. And it particularly manifests itself in the growthiest pockets of the market, but also more broadly across US markets. And clearly, the consensus narrative that has emerged at this point is calling for a soft landing. At the same time, the labor market remains very tight, and the more restrictive financial conditions haven't really translated into financial asset prices. And one way we are trying to make sense of this paradox is the highly accommodative fiscal policy we're still seeing. You can really think about the fiscal deficit as a stimulus, an artificial stimulus to the economy. And naturally, we're worried about the sustainability of the fiscal picture. So yes, 2023 was a very good year in financial markets, but we do see some risks, and we do want to be adequately compensated for those. Now, the S&P 500 is trading at about 2 standard deviations above its historical trading range on a price to cash flow basis. And the top 10 constituents of the S&P 500, they make up for about 1/3 of the index. They're trading at 27 times earnings versus about 17 times for the rest of the index. Those 10 companies were also up over 60% last year versus about 8% for the rest of the index. So when you think about those numbers, the good news for us is that while we generally speaking see this complacency in markets, there are pockets that are a bit more out of favor, that are a little bit more interesting to the market participants. And those tend to be more mundane industries, real estate, industrials, consumer staples, energy. But that kind of setup allows us actually to own some attractive businesses in the US at more modest valuations. And when you then peer outside of the US and look into international markets, the discounts tend to be quite high to US equities. And that again allows us to own attractive businesses internationally that oftentimes dominate their respective niches, to own these businesses at more modest, more attractive valuations. So for common sense, bottom-up investors like ourselves, the opportunity set today is actually quite attractive, despite markets more broadly embodying some complacency.
Absolutely. And this past year, we also saw historically tight monetary policy to combat inflation. Many think that this is potentially coming to an end, and that we may actually see rate cuts this year. So how does this impact your approach?
The Fed funds rate today is at the highest level in about 2 decades. The Fed funds rate is above 5% today, and that compares to the long-term Fed expectations of about 2.5%. So clearly, we're in restrictive monetary territory. But as I mentioned earlier, there's some offset from the very accommodative fiscal policies. We may be seeing some fiscal dominance at this point. Moreover, the wage growth remains quite high. It's above its 50-year average. So when you take that restrictive monetary policy combined with a tight labor market, what you see is that there's been some pressure on corporate margins. The S&P 500 earnings per share last year were only up 0.4%, as the strong sales growth was offset by contracting margins. Also, people seem to be very focused on the short term and on the imminent rate cuts. But the reality is, if you look at the longer end of the rate expectations, at the 30-year rate expectations, what you will see is that in 2022, rates reset from about 2% to 4%. In 2023, it stayed at 4%. The long end of the curve hasn't come down at all. So when you consider all of these facts, what emerges is that the crystal ball remains foggy at best. The real world is a complicated place. So how are we dealing with that kind of environment? And I think at First Eagle, we have a really ingrained approach to our investments. And the beauty of this time-tested strategy is that it supports us in our goal for resilient wealth creation throughout the ups and downs in the business cycle. Now, how do we do it? We curate bottom-up, resilient portfolios. And in these portfolios, we tend to own companies that are market leader in their respective niches, that tend to generate a lot of free cash flow, that tend to have quite healthy balance sheets. And importantly, we tend to own these businesses at modest or attractive valuations. The businesses we own, they do not tend to be priced for perfection. They do not tend to embody a ton of optimism in their pricing. We cast a global net when we curate these portfolios. We have some deferred purchasing power in the form of cash, which we're happy to opportunistically deploy during dislocations in markets. And lastly, as long-term investors that are focused on wealth preservation, we do maintain exposure to gold as a potential hedge for financial tail risks.
Thank you so much for this catch-up, to kick off the new year. So thank you, Christian. We look forward to speaking to you next month.
Thank you.